Hi there. In this presentation, we reach to the last part of the course talking about the partnership liquidation. And just before I start the presentation, I would like to ask you to get a few minutes to go to the course opinion survey and complete it for the advanced accounting. And if you are taking another course with me, like accounting information system, please do that. I really appreciate your feedback on the courses. It makes a lot of difference when I read your comments at the end of the semester. I'm so glad that we made it. We really made it. I know advanced accounting is one of the hardest course in accounting major, but I'm so glad that we made it together. The next point is that in this presentation, we will have a quick recap on what we discussed in the previous chapter, which is partnership, and then we see where we ended and how can we complete the cycle of the partnership. As you know, that this course was talking mainly about merger and acquisition between a parent and a subsidiary company. And we had like maybe 5 chapters talking about this topic. Then we talked about the intercompany transactions that might happen between the parent and the subsidiary, such as selling inventory or providing services or selling assets. And then we shift the gear into the reporting issue where the parent and the subsidiary might be located in 2 different countries and they use 2 different currencies. So we start talking about how we translate the currency from the subsidiary financial statement to the parent and make one set with one currency for both parent and subsidiary to provide a qualitative information to the stock market. And the last topic in this course is partnership. In the previous chapter, we talked about how to start a partnership. When partner A and partner B, they come together to start a partnership, everybody will bring assets, maybe liabilities, and the balance will be his capital. So how can we take the assets? We say we take the assets at the fair value. And then we take the liabilities also at the fair value. However, the liabilities will reduce the owner's capital balance. And then the partnership will start working and generating income. How can we distribute the income between the partners? Usually we give salary to the partners, and the salary we give to the partners is not an expense, it's part of their capital, which is part of the income. So we can distribute the income of the partnership in form of salaries. We can also distribute the income in form of interest on their average capital. And finally, if there is any remaining balance, we distribute it by ratio. This ratio could be 20-80, 30-70, 60-40. If there is no say about the ratio in the example, it means we distribute it equally. The third topic is admission of a partner. When a partner starts, sometimes they accept a new partner to the partnership. And then we talked about how can we admit a partner, whether by buying a share from the other capital of another partner, and this will create a transaction between the partners without the inclusion of the partnership in the transaction. Or the partner will provide assets to the company. In the same way, we talk about withdrawal. If one of the partners decides to leave, then he can either take his capital from another partner or take assets from the company. So in the previous chapter, we talk about 4 main areas: the starting of a partnership, the distribution of income, the admission of a new partner, the retirement of an existing partner. In this chapter, we talk about liquidation, which means dissolution. And before we start diving into this chapter, chapter 16, we need to differentiate between 2 different terminologies: disassociation and dissolution. Disassociation, we talk about withdrawal of an existing partner, and the withdrawal could happen to 3 different reasons. Number 1, maybe one of the partners passed away. So the death is a good reason for a partner to withdraw. The other one, if the partner out of his or her free will decides to leave, voluntary withdrawal. And the last one, judicial determination, if the court decides that this partner should disassociate from the company. If one of the partner leaves the company, it doesn't mean the company will stop. It means the existing or the remaining partners are eligible to buy the capital of the withdrawing partners, or they can tell him to recruit another partner. So the company will continue if one of the partner decides to leave. The dissolution talk about different issues. We talk about the liquidation, the winding up of the business, and this could happen when one of the partner decides to leave. We need at least 50% of the remaining partners to approve the withdrawal or the dissolution or the liquidation of the company. So if we have 10 partners, one of them decides to leave, and then we have 9. If we get the approval of 5 out of 9 partners to wind up and liquidate the business, then we can make the solution. So the solution, it means you liquidate the business, you sell the assets, you pay the liabilities, you distribute the remaining cash to the partners. If there is no withdrawal, but all the 10 partners agree to stop the business, then we can make a dissolution. Or if the partnership has a term, 10 years, 5 years, 7 years, and this term is expired. So there was a duration for the company and the duration stops. In this case, the company can be liquidated. Or if the company start to do some illegal act, and this will make a risk at the partner's life, then we can make the solution for the company. So good example, if the company is producing a product and some research came out to say that this product has high risk on the customer. So if they continue to produce the same product, this will create an environmental impact on the customers. So for that reason, the company has to stop. And finally, if the court made a decision for a company to stop. So this association, we talk about withdrawal of a partner, but dissolution, we talk about the liquidation of a partnership. How we do the liquidating? Number one, we take all the non-cash. So we divide our assets in the balance sheet, not current and fixed, but we divide it into cash and non-cash. So the non-cash will include accounts receivable, inventory, fixed assets, intangible assets, any non-cash, we sell it. And we might make a gain or loss. Most of the time, we get loss, except if we sell a piece of land. So when we sell the asset and we get loss, we distribute the loss among the partners by the ratio mentioned in the exercise. Then we have cash, we have partners, and the liabilities, whether accounts payable or notes payable. Who should take his money first? The creditors. So here you see that the creditors, once we sell the non-cash and convert everything into cash, we pay the liabilities first. What will happen if one of the partners give a loan to the company? And we have accounts payable in the company. Who should take his money first? The accounts payable or the loan that came from the partner? We say the outside creditors should take their money first, then the inside should take their money. And if there is any cash left over, we distribute it among the partners. I know life becomes easier when we get an example. So here is an example. We have a company that has 3 partners, Larry, Curly, and Mo. They share profit and loss in the ratio of 3 to 2 to 1. And they decided to liquidate the company. As you can see in their balance sheet here, we have cash and non-cash. It's not current and fixed anymore. And then we have the liabilities, like you could say accounts payable or notes payable. But then the company already took a loan from Larry and Mo. And then we have their capital here. So here we have liability to the outsider and the loans from the partner to the insiders. And we sold the assets for 42. So here we have the assets 90,000, but we sold it for 42. It means we made a huge loss. And who should take it? The three partners should take this loss. So step one, we sell the non-cash and distribute the loss among the partners. Step two, we pay the liabilities. Step three, we pay the loans to the partner. Step four, we distribute the remaining amount to the partner. And how can we make these 4 steps? We make this report, which we call it a statement of realization and liquidation. And you will see this report in the coming example several times. This report, in a very simple language, looks like the accounting equation, which you might have covered in the first class of accounting. In the left side, we see the assets. On the right side, we see liabilities, partner's loan, and partner's capital. And if we add the total amount of the left side, must be equal to the total amount of the right side. And now we come to the first step, which is selling the net assets for loss. So here in our sale, we made a loss of 48,000. And if we go back here, we need to divide the 48 by 3 to Larry, 2 to Curly, 1 to Mo. So here we add 3 plus 2 plus 1 equals 6. So we multiply 48 times 3 over 6. We get the portion of loss that will go to Larry. The second one, 48 times 2 over 6, 16 go to Curly. And the last one, 1 over 6, 8,000 go to Mo, and we record it that way. So the non-cash will be 0. The cash will increase by the amount received, and the loss is distributed among the 3 partners. And here is the balance. But look here, when we check Larry's capital, we see that his capital was 22. With his portion of the loss 24, his capital turned to be a deficit. So here, Larry has to cover up this deficit. And if he fails to do that, Curly and Mo should cover up his deficit. So the good thing that Larry has a loan. So how about we reduce his loan, and this will cover up the deficit, and this is what we do it here. So his loan will become 3,000, and Larry's deficit will be covered, and his final balance of capital is 0. Then we pay the loan to the outsider, 24,000. Then we pay the loan to the insider, 3,000 to Larry, 10,000 to Mo, and the final balance will be distributed to Curly and Mo. And this is what we mean by the statement of realization and liquidation. Now, let us go to the Excel file, which you will see it on the bright space. In this file, as you can see here, there are 6 different examples. I did the first example in the presentation, so here I start from exercise 2. In these exercises, we will go through the journal entries, the statement of realization and liquidation, the other issues that we might face during the liquidation. So here we have Mark, Luke, and John. They make a ratio of 5 to 3 to 2, and they are partners. And they decided to shut down their business and get their money back. We said, number 1, we need to see how we sell the non-cash assets. Are we going to make profit or loss? So here you see 161, it was sold for 120. Which means we made a loss of 41,000. 161 minus 120. How can we take this 41 and divide it among the partners? We put it this way, 5 to 3 to 2. If you add them together, you get 10. So here it's 5 over 10, 3 over 10, and 1, 2 over 10. So it means Mark will take 50%, Luke will take 30%, and John will take 20%. As simple as that. So now we need to do the statement of realization and liquidation, and we make the journal entry for that. So to make it easy here, I put them in the second sheet. Sorry. Here we go. This is the statement which you have seen something similar to it in the presentation, where we have cash, non-cash, accounts payable, look loan, and the capital. The first line, we usually take it from the example, from here, from these assets. So you see the cash, the payable, the loan, all of them are here. The first transaction is we sold the assets for 120. So the 160 will be subtracted, but we put 120 under cash, and the 41,000 difference between them we divided by 5 to 3 to 2. So we multiply the 41 by 50%, 60%, sorry, 30% and 20%. Then we subtract them, we get the balance here. And then we need to pay the creditor and then the loan. The accounts payable 31, the loan to Luke is 11. The creditor should go first, and then Luke should go second. And then we subtract 135 minus 31 minus 11, we get the new cash balance of 93. The liability and the loan will become 0. The capital balance will be the same. Then we take the 93 and divide it among the 3 partners, so everything will be 0. And as you can see here, I put 1, 2, 3, because those refers to the 3 journals I need to make. The first journal about the sales of assets, where we debit cash by 120, credit non-cash by 161, and the 41 between them we divided by 5 to 3 to 1. The second thing, we paid the liability and look. So we debit accounts payable, look loan, and credit cash. The third one, we paid all the 3 partners their capital. So here we debit Mark by 61, Luke by 25, John by 7, and we credit cash by 93. So in this example, we had seen how we make the statement of realization and liquidation and how we journalize the transaction. Now let us look at another example. Here we have a company, and the company has 2 partners, Todd and Pam. And they accepted the Chuck as a partner. They continued in business for several years, and they decided to liquidate the company. Remember the ratio, number 1. The ratio of Todd, 25%, Pam, 60, Chuck, 15. So what does it mean? If the company made gain or loss, we distribute the gain or loss among the partners by this ratio. And here the company sold collected the receivables 38. But if you take a look on the receivables 60. So what does it mean? The company collected the receivable into 2 different transactions, not one. In the first one, the company collected 39, but because of their collection, they lost 9,000 written off. And the company sold 50% of the inventory. If you look here, the inventory 52, the company sold 26, which is 52 by half, 26,000 for a loss of 6,000. And the partners estimated the cost of liquidation to be 9,000. So what shall we do now? We need to report here the schedule of safe payment, where we take the balances here from their capital account. So you can see here that the balance 10,239.58. We keep it here. Then we see 2 loans. One loan to Todd, another loan to Chuck. The loan to Todd, it's given by the company, so this should reduce Todd capital, but the loan that has been taken from a Chuck, this is a liability on the company, so it should increase Chuck's balance. So you see here, the loan from Todd reduces his capital, the loan from a Chuck increases his capital. Then we start to see the goodwill. We have to write off the goodwill. because he didn't say anything here about the goodwill, and the goodwill usually it's not like a fixed asset. It's intangible, and if we don't see any value for it, we have to cancel all of it. So we take the 27 divided by 25 to Todd, 60 to Pam, 15 to Chuck. And the receivables here, 9,000, which is written here. And the loss in the inventory, 6,000 here. We take the 9 and the 6 and divide them 25%, 60%, and 15%. Then we get the new balance. But when we get the new balance, we see Todd's balance became negative, which means deficit. But Pam and Chuck still they have positive balance. Now we need to sell the remaining amount of inventory and receivables. So here, as you see, the receivable 60. And we made collection of 38. The inventory 52. And we sold 26. So how much is the remaining? We get 60 minus 38. And here 52 minus 26. Sorry, 52 minus, we get 26. Then we add both of them, we get 48. Those 48, we don't see anything about them that they have been collected, which means they are lost. So how we distribute the 48, as you can see, 12, 28,800, 7,200. And if you are doubting, you can add those three and you will get 48. So here we distribute the loss of 48,000 among the three partners. And the last one is the cost of liquidation here, 9,000. We divide the 9,000, 25 to 60 to 50. And finally, the balance will be the total here, where we see the balance for Todd, it became really negative. And the same thing for Pam, but the Chuck still has a positive balance. So out of the positive balance of a Chuck, we will cover the deficit of Todd and Pam. And the remaining amount, the 18,000, we call it safe payment. What does it mean? After we absorb all the losses and we pay all the liabilities and we cover all the deficit of the partners, the remaining balance, we call it safe payment to the partner. Now let us go to the next example, number 4, where we see three partners. They have a company and the ratio is 2 to 3 to 5, and they decide to liquidate the company. So here we see the cash, we see the non-cash, but we see a loan from Alan here, which should reduce his capital. And we have liability and the capital balance of the three partners. And here we have three different transactions. The first one, we sold 93,600. But if you look at the assets here, they are 215, which means we sold part of the other assets. So if I put here 215,000 and I sold 93,600, the remaining balance will be 121,400. How much did I sell the 93,600? I sold it for 86,500. So how much loss did I make? I made a loss of 7,100. And the second one, which is step 3, it say we sold the non-cash for 78,500. So how much loss did we make? We made 42,900 loss. On the other side, we have liability 73,700, where we paid 45, and the remaining balance had been paid later. So we have 73,700. We paid 45. So now the balance that needs to be paid is 28,700. In addition, we pay 48,800 to the partner at the end of each month. So now we need to do again the statement of realization and liquidation. Here you can see that we get the balance from the balance sheet. Then we need to write off Alan's loan, which should reduce his loan and his capital. So his loan will become zero and his capital also will become zero. And then we make the first sale transaction for the non-cash. Here you go. We have cash 86,500. We sold the non-cash 93, and we have 7,100 here, which we put it. So we take the 7,100 divided between Alan, Patrick, and Blake. And then we make the payment 45 to the creditor, and here there is no gain or loss. And then we add the total amount here. Then Alan loan will become zero. The non-cash will be reduced. The liability will be reduced, and the capital also will be reduced. Then we need to make the payment to the partner. As I said, we make it by the ratio 2 to 3 to 5. So we take the 48,800 divided by the same ratio. So here you go. The payment of 48,800. Then we get the balance after this payment. Then we make the second sale of assets, which will take us to 78,500, and the difference will be loss. Then we make the payment to the creditors here, the second portion of the creditors. This will make the loan zero, the non-cash balance zero, the liability zero. But look here, you will see that we have positive balances for all the three partners, which means no deficit, which is good. So now I distribute the remaining cash among the three partners. As I keep repeating in my presentations, please, whenever you do the example, stop the video, go to the Excel file on Brightspace, try to work out the answer, and then come back to check your answer here. Exercise 5, we have three partners, Corey, Derek, and George, and they make the ratio 15 to 40 to 45. If we add all of them, we get 100. So now, with the ratio for the first partner, 15% for Corey. The ratio for the second one, 40% for Derek. The ratio for the third one, 45% for George. Now we see here cash, but I don't see non-cash assets. I see accounts receivable, inventory, property, plant, and equipment. So what we need to do, we need to add all of them. If you add the three assets here, we get 499. But it says here, we sold it for 267. So here we put 267, 200. So the difference will be this amount, 231,800. I need to distribute 231,800 by 15 to 40 to 45. But here is the point. We see a new point that I didn't address in my previous examples, what we call it personal net worth. What does it mean by personal net worth? Is each partner has general liability for the partnership, which means if the partnership fails to make the payment to the creditors have the right to claim their money from the personal assets of the partner. However, we need to calculate the net worth, which means we add up all the value of the assets of the partner minus his liabilities, we get the net worth. The net worth is the maximum amount that the partner can pay out of his assets. So we have this one, we keep it in case one of the partners make a deficit, then we will go back and take the cover from these amounts. So here we check, it's again the statement of realization and liquidation. And by the way, I put this here balance sheet next to me in case I need to get information. I don't need to keep jumping between the two sheets, and I do this for all the examples. So first we need to get the balance from the balance sheet. We have cash, and I added all the non-cash. Then we have liabilities, Corey, Derek, and George. And then we have here the payment, 267,200. Then we have Corey, Derek, and George, each one of them absorbing a portion of the loss, because if you remember, I said we will have 231,800. We divided by 15 to 40 to 45, which you can see it. So now we need to get the balance. The non-cash will become zero, then the cash. But then you see, when I start to distribute the loss among the partners, we see that Derek and George, they get a deficit balance in their capital. Both of them, they have net worth that can cover some of the deficit. Which one I should take it first to cover up his deficit? I will take George, and I will tell you now why I am taking George. So George has 38,310. However, his deficit as his net worth is 31. So out of the 38, he can cover up 31. So still there is a deficit of 7,310 on his balance. Who should pay for it? Since George cannot pay, Corey and Derek should absorb it. By which ratio? We call it here 15 to 40. But we don't take the 45 of George because George had left already. So we add them together, we get 55. Then 15 over 55 and 40 over 55. Here we get 27% if you divide it, and here you get 73%, which means I take the 7310 divided between Corey and Derek by this percentage, 27% and 73%. And then when we add the loss, Derek's deficit will increase. So if you try to cover up Derek's deficit here first, you will see that there is another deficit will come that he needs to cover. So this is the reason I put George first before Derek, to make sure that Derek will cover all the losses in one step. That's all. And then we get the balance here. So Derek will cover up his balance of 42 because his net worth is 69. So he's good to go now. So we end by the capital for Corey, 89,236. And then we pay the liabilities, and the balance will go to Corey. And this will be the end of the exam. So please remember all these issues in liquidation, how we distribute the gain or loss, how we make the safe payment, how we complete the report of realization and liquidation. The next example is journal entries. And here we have a company, and then we will go through it. So here we need to make the journal entries. The first one is we made the sale of the asset and we made losses here. So we made a loss of the accounts receivable, inventory, equipment, and then we make accounts payable and then the capital. For the sake of convenience, I will stop my video here and I will make exercise 6 and 7 in a separate video so you can take a break and you become more focused with me when I do the second 2 exercises. So I will make them in a separate video. Thank you so much. Bye-bye.